Hello, dear friends. Welcome to Tusha's Education Hub. And today we are going to decode what is financial management and its some of the components. So let's start. Firstly, we will learn about what is the meaning and concept of finance, its scope, finance function, or we can say financial management function, its goal, and what is the conflict between shareholder interest and the interest of managers and lenders, agency cost and its theory, or we can say agency cost solutions. So let's we learn about the meaning and concept of finance. Talking about meaning of finance, financial management is a managerial activity that concern with the planning of finance. Now, friends, planning of finance means acquisitions of finance or acquiring finance is the best available rate, or we can say the best rate of interest. It can be a debt or it can be equity, and controlling of the firm's financial resources. And after acquiring that, the job of financial manager is to see that the acquired finance is used at its best, or it is used efficiently and effectively. The primary goal of financial management is to maximize the wealth of shareholders. Now, as we know that the shareholders are investing in any of the firm or any of the company in order to get the best available returns. Now, if a firm will not be able to satisfy the shareholder, then shareholder might withdraw their money, or the shareholder might be dissatisfied with the company. Hence, the goal of financial manager or goal of financial management is to maximize the wealth of the shareholder. That is the prime goal of financial management. Okay. Now let's talk about the scope of financial management. As the scope, the first scope says that management of real and financial assets. The one of the scope of financial management is to management of real and financial assets, or we can say the assets of the firm. Real assets include tangible assets that we can touch and feel, like building, laptop, land, machineries, vehicles, etc. And the intangible assets are the asset which we cannot feel and touch nor we can see, but yes, they are giving benefits to the business, that are known as intangible assets. Intangible assets include patent, copyright, trademark, software, franchisee, agency, like such. So the financial management manages, or they see that what asset mix is beneficial for the business. Firstly, the task of financial manager is to see that what sort of asset mix is beneficial for a business. If a business is getting more profit from their operating activities, in such a case, the manager will allocate more funds to the real assets rather than allocating more fund to the financial assets. Now you might be thinking that what are the financial assets? Financial assets are the nothing but they are financial securities. Financial securities mean equity shares of any another company, or preference shares of any another company, debentures of any another company, or bonds which are issued by the government, ETFs, mutual funds. Such assets or investment avenues are known as financial assets. And the real assets are the assets which are owned by a company, which are used for some sort of production, or for some operations of the company. So such assets are known as real assets. Now, the task of financial manager is to see that his company is earning more profit from their own businesses or from their own operations. Then the financial manager will allocate more funds to the real assets rather than allocating more funds to the financial assets. If the financial manager feels that the business might have some downfall, or the business may not able to earn more such profits, then he will allocate a more proportion of assets into the financial assets, so that the rate of return which investor or shareholder expect from the company meet towards their expectations. Now, talking about real assets, there are two kinds of assets in the real asset. One is tangible, another is intangible. So financial manager assess or evaluates the situation of the firm, and then he allocates the funds as per the requirement to the uh, best situation or best asset mix, so that the firm can able to earn more returns or maximum returns in the long run. Now, another scope is management of equity and borrowed funds. Now, friends, as we know that as we are acquiring assets. But for acquisitions of assets, the company needs funds. The company needs capital. Now, the capital or funds can be mainly divided into the two parts. One is equity and another is debt. Now, what does equity or equity capital means? That equity capital means that the capital which brought in the business by the owners or by the shareholders of the company. Now, equity capital is further divided into major two parts. One is ordinary equity share capital. That is, they are the true owners of the company. There is so ordinary share in the ordinary share capital, the company gives dividend if the companies get good profit. If a company is earning less profit, they give less dividends. If company is not earning any sort of profit, they might omit or they might skip to give dividends to the shareholders. So as they are the true owners of the company. On the another side, if a company is earning more returns, they need to give more dividend. Talking about preference shareholders, they are not true owners of the company. Yes, company needs to give them fixed amount or fixed percentage of dividend, the amount they had invested. They are not true owners of the company. But on the another side, they are given some of the voting rights in the company. So they are known as owner, but not that. But they are not true owners of the company. Other than that, the way of raising equity capital is right shares. Right shares are the rights which are given to the equity shareholders. If a company want more capital, they issue their shares to to their shareholders, and rights are given into the proportions to the shareholders. Other than that, company may raise their funds from their IPO, that is initial public offering, or FPO, further public offering. If company is listed, and still further on, if they need some funds, for an example, recently, not recently, but way back around 1.5 year or 2 years back, Yes Bank has raised their fund from FPO. They do further on public offer means once they had done IPO, and if a company is issuing their shares in the public second time after the IPO, that is known as further on public offer. So these are the ways from which equity funds can be raised. So the task of financial manager is to assess that which way is better for the firm, which way is cost effective to the firm in short run and in long run too. Other than that, now we will see about what are the borrowed funds. Borrowed funds. Talking about borrowed fund is purely debt capital for the company. That means that uh, they are not owners of the company. They had given loan, or the company promises to pay them their funds along with the fixed rate of interest that company need to pay from the to the firm or to the person from whom they had raised their capital. So talking about that, the way to raise the debts are loans from the banks and financial institution that can be secured and unsecured loans. There are two sort of loans, and debentures. The company can also issue debenture to the public. And now, what are the benefits of raising capital through debt? If any firm raise capital through their debt, uh, the amount they pay to their investor in the debt, that is interest payment. It is a deductible expenses from the tax. So a firm can get benefit into the taxes. Other than that, the cost of equity is quite high than the debt. So, yes, I agreed that that is a two-sided sword. See, it is a pure leverage. That is a pure financial leverage, and if uh, the firm is able to earn good profits from the debts, there will be a good benefit to the firm. But on the another side, say interest isn't fixed to payment. A firm need to do to the firm from them who had borrowed the capital on the regular basis. If the firm is not able to earn such a profits, it might be hazardous to the financial health of the firm. Now, here comes the task of financial manager. Financial manager assess what proportion of capital mix is beneficial for earning maximum returns. On the another side, he also assess that how much minimum risk, or what is the best capital mix a manager can design so that the firm can able to earn maximum returns with the minimum risk. That proportion mix or that capital mix, the financial manager will plan out, and on such capital mix, the financial manager will borrow capital from the market. That is, that can be equity and that can be borrowed funds. So, management of equity and borrowed fund is a very crucial task for a financial manager. Okay. Now the third scope is finance and managerial functions. We know that finance is required in all sort of forms, whether it is an IT firm, whether it is a production company, service company, FMCG company, banks, everywhere. And other managerial functions which are conducted in the firm goes hand in hand with the finance. For an example, if when there is a starting of the firm, the first task or first managerial function comes in the picture is planning. Now, in order to plan, you need to have some special uh, experts for planning of the firm, for establishment of the firm, such hiring of the experts, or for such recruitment of experts need finance. See, nothing. Each activity needs funds. Each activity needs finance. After hiring of such or recruiting of such experts in the firm need to plan out to organize something. For organizing everything, the firm need to purchase assets that can be land, building, machinery, vehicles. For purchasing such assets, firm also needs funds. Uh, for doing any sort of activity, from purchasing a raw material to the giving to till the giving the dividends to the shareholder, firm needs finance. So finance, and I can say that all other activities go hand in hand in the finance. Firm cannot any firm cannot live without finance or without managing their finances. Now, what are the finance function? The function of finance is raising funds, allocating them, and distributing profits. So, as I say that none of the firm can live without managing their finances. It starts from raising the funds, as the task of the financial manager starts from the initial stage of the firm. That from which source is the best or the cheapest rate, the cheapest finance is available. Other than that, after acquiring such finances, the task of financial manager starts that he need to assess various projects, various available opportunities where the funds can be allocated. So he does the research, he analyzes, he evaluates, interprets so many such reports and data available with him, and then he decided which sort of allocation mix is beneficial to the firm in the long run, with the maximum profit possibilities and minimum risk. Sorry, minimum risk. Other than that, after earning such returns from the various sources or various operations, the task of financial manager is to distribute such profits. Distributing profits to the debt is in the form of interest, but the main task for distribution of profit comes where there are the shareholders of the company or equity shareholders. Does the whole profit needs to be distributed, or some sort of profit or some ratios of the profit need to be written? What sort of profits need to be retained in the company, and what sort of profit need to be given to the shareholders, and by which way the profit need to be given to the shareholders, so that uh, post tax they get maximum returns in their hand. So it can be in the way of dividend, can be in the way of bonus share. So the task of financial manager is such, from starting of the firm till the ending of the firm, the financial manager is intact by managing their finances. So, talking about financial function, the first financial function is long-term asset mix or investment decision. Now, for asset mix, the firm adds financial manager in order to do the capital budgeting. Capital budgeting is a nothing but the process of assessing that what sort of investment opportunities is good. Again and again, I am saying the same thing, at the maximum available profit or maximum expected profit and with the minimum risk. So, for the capital budgeting, a financial manager does a very basic thing, that is expected. They calculate expected risk and expected return for a certain operation or for a certain activity. And after calculating such expected risk and expected return, there are many strategies and methods to calculate such expected risk and expected return. Uh, then he decides what amount of or what proportion of capital need to be allocated into the certain activities. For an example, taking an example of any one of the biggest conglomerate, for an example, Reliance. Reliance is having ample of opportunities, and they are also having huge amount of fund. So there are financial managers available with the Reliance Industries, and they assess that is the project viable, is the project is able to earn maximum return with the minimum risk. After assessing such all parameters, the fund is being allocated to the various activity. Other than that, the financial manager also takes care about the diversification of the funds. It is not that the whole fund need to be allocated into a certain activity which is having expectations of huge returns. But on the another side, the task of financial manager is also to see that he should not put a firm into a situation where the risk is very quite high. So the task of financial manager is to also see that he diversifies the fund of the company so that in the uncertain situation, see, we cannot predict external factors. External factors can be changed overnight. It can be changed into some hours or some minutes or some seconds. It's not in any of the hands. But yes, managing the risk, long term risk, is in the hands of financial manager. So he also sees such factors. Other than that, opportunity cost of the capital. As I see that he assesses all the available opportunities of the capital. So manager also thinks that a financial manager that if he is not allocating of for an instance X amount into A activity, does such funds is able to earn more returns than the A activity. So you also calculate that opportunity cost of capital, and on the basis of such parameters, he takes a decision that what amount of the capital need to be allocated for what long-term assets or for what sort of investment decisions. Now, the second function is financing decision. As we also discussed earlier, optimum capital structure is being designed from the financial manager. And the capital mainly includes two ways to raise the capital, that is equity and debt. And the care is being taken from the financial manager itself that the proper proportion or the optimum proportion of the equity and debt is being raised so that the equity shareholders need that earn more returns. uh, but on the another side, it is also being taken care that the firm's debt capital need to be kept in a certain proportion that in the adverse situation, the firm does not fall into some sort of risk or some sort of undesirable or adverse effect of the financial health to the firm. Talking about the leverage, the manager also manages the leverages of the firm. That is that leverage is nothing but when a firm is able to earn more returns due to certain thing that is known as a leverage. Now, dividend decisions. Dividend decisions are the part of distribution of the profit or dividend. Yes, as as we know that the prime goal of shareholders or any of the stakeholders of the company is to earn something from the company. So a shareholder needs dividend or returns. The task of financial manager is to assess that what amount or what ratio of the earned profit need to be distributed among the shareholders and what amount need to be retained in the company. Now, such calculation is being done on the certain factors like available investment opportunities in the company. So now, if the huge investment opportunities available in the company, the firm does not distribute profit among the shareholders. Rather than they think to reinvest such funds into the another activities, if the rate of expected rate of return is more than the expectations of the shareholders. Other than that, if the firm is expecting certain sort of uncertainties in the future, So they think to retain such amounts in order to sustain or in order to be stable or maintain stability of the financial health of the firm. So in such cases, the firm retain amount of the dividend, and the main thing is expectations of the shareholders. So if the shareholders are expecting more and the firm is able to earn lesser returns, they they they, they give more, major proportion of their dividends to their of major proportion of profits as a part of dividend to their shareholders. For instance, we know that the giant company of India, MRF, its price is around 1,40,000 something like that as of now. 1,43,000 to be very precise. But the MRF is having ample of investment opportunities. Hence, they are not distributing huge amount of profit as a part of their dividend. They are just giving merely 1, 2, 3, 4 rupees as a part of their dividend, as they are having huge investment opportunities. On the another side, talking about petroleum companies like IOC, BPCL, HPCL, they are not having more investment opportunities. As we know that uh, the petroleum or the oil marketing companies are there at the saturation level, so they simply distribute their profit earned from their businesses to their shareholder, and they say their shareholders that you can invest your amount at your own choice or at your own pace. So such sort of factors, such sort of thinking process takes place to the financial manager while deciding about the distribution of profits. Now, liquidity decisions. We frequently say that liquidity is a blood of the business. Now, why blood? A simple example: the task of the blood is to convert certain elements into the body. For an example, when you eat certain food, it need to be converted into carbohydrate, and then such carbohydrate need to provide you energy, and so on. The task of the liquidity is also the same. The liquidity is a blood of the firm. It is not blood of the body, but it is a blood of the firm. Why so? If the firm is able to maintain the liquidity in the required proportion, then they can purchase raw material or the goods if they are available at the good rates. So they can able to grab the opportunity. Other than after grabbing the opportunity, they can produce it or they can sell into the market, and by selling it they just convert their products into the receivable. After conversion of receivable, they convert it into the cash or a bank. So this conversion takes place, and in these conversions the firm is able to earn the profits. Hence, liquidity is the blood of the business. So it is a very crucial, and we know that the majority of the businesses, I don't remember the exact percentage, but it is around 70%. I just not remember, but around 70% of the businesses are being insolvent due to non-maintenance of the liquidity of the firm, and they are being insolvent and they need to shut down their businesses. So it is a very crucial task for a financial manager to maintain the adequate liquidity or required liquidity. It should not be more, as the liquid assets are not being able to earn more returns to the firm. But on the contrary side, it should not be a less, as if the firm will be able to get or maintain less liquidity, they would not able to grab opportunities, or it is not dangerous, but the dangerous part is if the firm will maintain less liquidity, they will not able to pay their obligations, regular obligations. For an example, salary, um, interest or EMIs to their banks, etc. and etc. Now, what sort of factors play a role? Firstly, the amount of current assets the firm is having. Other than that, liquid asset, current assets, liquid assets, both are very different. Yes, current assets are the asset which can be converted into the cash within a year, but on the contrary side, liquid assets can be quickly converted into the cash. For an example, current assets can be stocks, spare parts. Such things are known as current asset. Even cash is also known as current asset. Bank is also known as current asset. But yes, liquid assets are the asset which can be quickly converted into the cash. They takes a very lesser time to be conversion into the cash. Other than that, current liabilities or the obligation the firm need to pay in the short run, and other than that, available opportunities or business opportunity. Now, what is the opportunity? For an instance, if a firm is being operating their seasonal businesses of an firecracker, so if a firm maintain lesser liquidity into the months of February, March, April, it is okay as there are fewer opportunities will be available into the upcoming months. But talking about maintenance of liquidity into October or November, the firm need to maintain high level of liquidity as the the more business opportunities will be available into certain months due to Diwali. As there is a time of Diwali, the firecracker company will need more firecrackers to be sell into the markets. So here there is a more need of liquidity comparing to the regular months of the year. So this is also one of the factors that financial manager consider while maintaining the liquidity of the firm. Now, what are the goals? The main the main and the prime goal of the financial management is to maximize the wealth of the shareholders. Now, uh, one of the other goal is profit maximization. Now, what is profit maximization? Profit maximization is the rise in the profit earned by selling certain goods or services. Now, how profit maximization can take place? Firstly, the firm can rise their sales. If a firm is able to sell 100 units, so if a and can earn 1,000 rupees by selling 100 units. So if a firm sells 150 units into the next month, then firm will be able to earn more than 1,000 rupees into the next month. So this is one of the ways that firm can maximize their profit by rising their sales. Other than that, firm can rise their profit. If the firm is able to sell one particular goods at rupees 100, and if a firm is able to sell that such goods at the rate of 110 rupees, so a firm had increased their profit by 10 rupees. So by doing such, the firm can able to maximize their profit, but practically it is not possible because we are living into the perfect market. Majority of the goods are being to the perfect market. So if the firm will raise the sales price, there will be the loss of market share or loss of the customer. Other than that, decrease into the cost. If a firm is selling a certain product, for instance, a product at the 100 rupees, and the cost of that product is 40 rupees. Now, if the firm is able to produce such product into the 35 rupees, then also there will be gradually rise into the profit. But on the another side, decreasing the cost need to have some sort of investment into the that investment can be investment into the newer technological machines. Other than that, investment in by training the employees to produce more efficiently. Such sort of investment need to be takes place. So a task of financial manager is to assess that whether if we do such investment, is it beneficial for the firm into the long run, and yes, if the net result is profit. By taking such decision, the financial manager takes the decision. If the net result is not profit, the financial manager omits to do such. And yes, profit maximization is a very short term concept, it is not a long term concept. Another goal is the main goal of the financial management, that is wealth maximization of the shareholders. As we know that any of the person that invest into the any firm, the prime goal is to maximize their wealth. Uh, there is none of the another goal. We just don't invest into any of the company because, like for instance, I don't invest into Reliance Industry because I like Mukesh Ambani. It is not such. Any of the person invest into the Reliance because they want to grow their wealth. So, what is wealth maximization? Raise into the value of the home. Now, the person will think that how to calculate the value. Value can be calculated from the market capitalization, rise into the share prices of the firm, or rise into the assets of the firm, and long term. And yes, such a concepts are very long term into the nature. So, if a firm will able to earn profits on more profits on the regular basis, there will be the rise in the value of the firm, rising in the value, that is rising into the assets of the firm, results into the rise in the share prices. As the assets of the firm will be rising, there will be raise into the share prices of the firm. As yes, there will be rise into share prices of the firm, the market capitalization will be also raised. So, and such concepts or a such goal cannot be achieved overnight, but yes, it can be achieved into the long run. Now, the third goal of the financial management is to manage the risk. So it is not that if the financial manager is being told that you need to maximize the wealth of your shareholders, then he might take a decision which sometimes in the uncertainty may result into the collapse of the firm. So the task of financial manager is also to see that taking any of the decision which having probability of earning maximum returns or maximum profit. But on the another side, he should not take a huge risk that results into collapse of the firm. So for that, there are certain methods or strategy of calculating expected returns and the risk. And other than that, the task of financial manager is to hedge firm against the risk or mitigate the risk by the way of insurances and so on. And the fourth goal of financial management is growth and expansion. Growth and expansion is a in the terms of market share. Um, so every day, a financial manager is just seeing that the market share of their firm and the efforts are being made to raise their market share. As market share will be raised, there will be the rise in the profit into the long run, which will result into the wealth maximization of shareholders. Other than that, they also see that the revenues across the year can be raised. Revenue can be raised from the 2 years. Firstly, increasing the market share, and another is increasing the revenue per customer. If the revenue per customer is being increased, then also there is a growth and expansion. The best example available in nowadays market is telecom sector. Once there was a time the ARPU, that is average earning per user. ARPU, that is a short form. ARPU, average revenue per user was around 350 rupees of the G, and currently it is around 425 450 rupees per user. So efforts are, and we know that we are seeing that the price of and mobile data is constantly rising from past 1 year. So the steps are being taken to raise the revenue rather than raising their market share. They are also taking steps to raise their market share, but we know that it is very difficult to raise market share. So the steps are being taken to raise their revenue and spreading business across the geographies and sectors. The efforts are also being made to spread their businesses across the various places available into the world and various sectors. If the firm is having a huge amount of fund to invest, they will also plan out that in the what sort of sector they can be working, and by doing such an activity, there can be growth and expansion of the firm. And now we will decode that what is the conflict between shareholder interest and manager and shareholder interest and lenders. Now we know that shareholders are the true owners of the company, and uh, they are investing into any of the company in order to maximize their wealth or the prices of their shares. On the another side, managers are the employees of the company and they are working into the company. Their goal is to earn maximum salary. Other than that, the another goal is job securities, and the decisions taken by their manager is on the that side that they satisfy their goals rather than shareholders' goal. Uh, so many a times, shareholders want that the manager should take certain sort of risk in order to earn maximum returns. But on the another side, the manager thinks like that if firm would not be able to means would not be successful in taking such risk, and if there might be a collapse of the firm, then what what job securities they might be having. So certain times there is no inline of the goals of the shareholders and the manager. Uh, the shareholders always wish that the manager should be given lesser salaries so that they earn more profits. On the another side, shareholders sees that we want more salary because we are working, and in this case, the shareholders will be getting lesser profit. So there is a conflict between shareholders and the manager, and for such for such the arrangement that shareholders make to supervise the manager, that incurs a certain cost. Such cost is known as agency cost. So a firm need to also pay agency cost in order to manage their managers or the employee. Now, what is a conflict between shareholders and the lenders? The shareholders are always mostly interested in taking the risk in order to earn the maximum return. But if they are talking about the lenders, they wish that the firm should not take high risks, as the financial health may be affected, and affecting their financial health may result into the, and if the firm collapse, there might be a possibility there the debt given by the lenders might be vanished. So always the debt holders or the lenders are asking for the more interest. On the another side, shareholders want to give lesser returns so that they can earn more profits. So these are the two conflicts that are happening between the shareholders' interest and lenders. Now, we many a times think that what is the solution for this. So agency cost. First, we will see that what is agency cost. Agency cost is a cost associated with the conflicts of the interest between principals, that is shareholders, and the agents, that is the managers or employee of the company. And these conflicts arises when the agents who are entrusted with the making of the decision on the behalf of the principal. As we know that the shareholders are not directly involved in the taking small decisions of the firm every day. But in order to see that, or in order to control that, the managers take true and fair decision in the as per the policies of the shareholders. Certain sort of supervision is being needed on the managers or employee. Such a cost of supervision is known as agency cost. Now further we'll more decode about that. There are various agency costs. First one is monitoring cost. Monitoring cost is a nothing is a cost of supervision of an employee or a manager. Now the residual loss, the loss that is a difference between the value a firm could have generated solely in the principal interest and the value actually realized due to the agency conflicts. As I told that many a times there is a differences in the goals of the principals, that is shareholders, and the managers, that is employee. So now, certain times, if shareholders take certain decisions, and they would might be able to earn more profits than the employees. So, such an opportunity cost is known as residual loss. That a firm could be able to earn more that profit, but due to as the managers are managing such firm, the firm is not able to earn. And the third one is opportunity cost. Agents may forego the opportunities would benefit the principal, but the conflict of his personal interest. So opportunity cost is also that certain times the manager forego the opportunity, as the grabbing opportunities resulting into the taking various challenges and working for it, and mostly the employees doesn't want such challenges, so they may forego such, and such a cost is known as opportunity cost, that is a part of agency cost. Now, what is agency theory? Agency theory is a theory which examines the relationship between the principal, that is an owner, and the agents, that are the managers and the employees of the company. Now they just analyze and they see that by for which reasons the conflicts are being taken place, and for their conflicts certain solutions are being given into these theories. Such solutions are there. Incentives alignment. Now we know that what are the incentives if a certain employee is being to give more profits to the shareholders, or more profits to the firm rather than shareholders, we can say the firm. The firm will give them certain portion of additional profit that firm earn. Such a profit additional such a portion of profit is called incentive to the employee. So when the incentive concept was being performed in the company, then then the manager will think that if they will able to earn more profits to the shareholders, the firm will give him the more some sort of proportion to them. Hence, they will work in the way that the wealth of the shareholders is being maximized. Now, implementing such, there is a need of monitoring and oversight. That is the cost of supervision, and there are many a times there is also contractual agreement between the firm and the employees, that about the rights and responsibilities and incentives given to their employees, and the corporate governance and the firm, that is the shareholders are being working in a way that they can do a best corporate governance, so that the employees are being motivated and they act into the way that the wealth of the shareholders is being maximized. And the another also one thing is the employee stock option scheme. Uh, by 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 giving employee stock option schemes, the firm tries to give certain portion of ownership to their employee. Hence, any of the employee or any of the manager is also a manager. On the another side is also shareholders of the firm. So they act in the best interest of shareholder rather than acting in the interest of the manager. Hence, on the another side, if the manager will act there, his wealth will be also maximized, and the shareholder's wealth will be also maximized. Uh, thank you, and I hope you might like my video. You can comment if you are having any questions. Further on, you can subscribe, as this is my first video. You saw I will upload videos regularly on this channel. You can subscribe, and you can also share this video to your fellow friends or colleagues into your class. And for getting notifications of my video, you can turn on your notification button. Thank you.